Hey guys, welcome back to my channel, McNallie Money, home of all things stock, investment, and personal finance related. Now, what a week we're having in the market. Tech stocks are selling off in a massive way, and a lot of companies are starting to look very attractive at these prices. The one I wanted to talk about specifically today actually came out with earnings late last week, and this is a company that I've been very bullish on and actually hold myself, none other than Dropbox. So we'll get into their earnings report, both Q4 and year end. But I wanted to really take a deep dive into this company because I feel like they're getting pulled down in relation to the overall market. And I think at these current prices of low 20s, it's a very attractive value proposition. So without further ado, let's get right into the video. Please take a second to like and subscribe to the channel if you haven't already. And leave a comment below if you're currently holding Dropbox or looking to get involved in this company in the near future. Okay guys, so as promised, today we're going to be talking about Dropbox, specifically earnings and some recent news that just came out about the company. Now this is one that I wanted to talk about last week. Earnings came out Thursday, but I didn't get a chance, so I wanted to make sure we talk about it here because we're seeing some big price movement in the last couple days. So yesterday it was down 4% or almost $1 per share. And as of right now, pre-market trading, it's down another 3%. So this is getting very attractive at under $22. There's a number of things I want to talk about in the earnings transcript as well, but I figured we should take some time and discuss this in more detail because this pullback might be a perfect opportunity for some of you who have been watching this company for a while. Now this is one that I've talked about before. I'm extremely bullish on Dropbox long term, and I think this little pullback is a great opportunity here. Now before we get into the actual earning transcript, I wanted to point out a couple numbers on this page. So if we pull out to a 5-year chart here, you can see that it's been trading in this low $20 range, even high teens, all the way back to December of 2018. But in that time, the company's made some major strides and really changed the face of their business in material ways that I don't think the market is really reflective of right now. The other number that I wanted to look at closely, and this is one I want you to remember for later in the video, is the market cap. So keep this 9.3 billion in mind as we move through the call and as we start to talk about some of the factors that the company released on their earnings transcript. Now if we scroll down the page, one other thing I wanted to point out here, you can see Q4 2020 did come in as a beat. I released a video about Dropbox a couple weeks ago and I was predicting that this beat trend would continue. So this is now 4 straight quarters here in a row, and you can see the annual earnings continues to increase along with quarterly earnings as well. Okay, so moving along here into the actual fourth quarter and F20 results or earnings transcript, there's a lot to unpack here, you guys. So I wanted to go through it kind of line by line. But before we get into the numbers, I wanted to just read what the CEO here, Drew Houston, had to say. So 2020 was a transformational year for Dropbox, and I'm proud of the team for their resilience and focus in addressing our customers' evolving needs. We ended the year with strong margin expansion, free cash flow, and more than $2 billion in ARR, which is annual recurring revenue, as we continued to make progress towards long-term financial targets. Going into 2021, we're focused on executing against our strategy and building essential products for the new era of distributed work. So again, this work from home shift or culture has really benefited this company in a lot of ways. Obviously, file sharing and storage is their core business, but a lot of these auxiliary businesses like HelloSign and things like that are starting to come online and add to overall revenue really benefit from this type of environment. So we're going to start with fourth quarter results here, and I'll just go through kind of each point and then talk about my personal opinion on it. So total revenue was over $500 million, which is a 13% increase from the same period last year. So double-digit growth in terms of top line revenue. Annual recurring revenue ended at just over $2 billion. So that's the amount of money that they're flowing into the business each year. This increased 41 million quarter over quarter, and again, double-digit 11% year over year growth on a consistent currency basis, so adjusted for currency exchange. And it would have been 12% without that currency fluctuation. Paying users ended at 15.5 million people, or 15.5 million customers that subscribe to their pay services, as compared to 14.3 for the same period last year. So they're up over 1.2 million paying customers, which is phenomenal. And the better part about this is the average revenue per user was actually up over $5 to $130 per individual user compared to $125 last year. So not only does this show they're attracting more people to their business model, but the people that are already using it are finding more value and actually paying more than they were previous year. years. GAAP gross margin was 79%, so phenomenal margins compared to 76.5% in the last year. So again, they're able to squeeze more money out of that revenue and increase their margin profile. And non-GAAP adjusted was 80% compared to 77.6%. You'll see one of the big reasons for this difference as we move into the notes at the bottom here. It was to do with their actual inventory of property or locations. And now as they shift to this work from home model themselves, they're taking some write-downs in terms of property and rental expenses. On this point again, you can see a big discrepancy between GAAP adjusted and non-adjusted operating margin. But the non-adjusted, when we take out these one-time expenses, was up over 25% compared to 15.6% last year. So nearly a 10% jump there in operating margin, which is absolutely phenomenal. If we take a look at their actual earnings or net loss for the quarter, you can see here they recorded a $345 million loss that's GAAP adjusted compared to a $6.6 million in the last period. So this number does kind of scare people off if you were to just read this point form and not look into the whys behind it. But if you see here, the non-GAAP was net income of $118 million compared to $67 million in the same period last year. So again, when you remove out that one-time property or rental expense, you can see the numbers really start to improve here. We then move into net cash provided by operations. So this was $171 million compared to $187 in the same period last year. Free cash flow was $158 compared to $161. So very similar year-over-year profile there in terms of net cash and free cash flow. And you can see these ones were not impacted by the one-time adjustment here. This is just amount of cash that's coming into their hands. And then the final point here is just the net income or loss per share. So you can see here, GAAP basis, it's a loss of 84 cents a share compared to a loss of 2 cents in the same period last year. But if we strip that out, you can see they've actually earned 28 cents per share compared to 16 cents per share in the last year period. Now this is a 12-cent per share earnings boost over last year's same period. So if you take 12 cents and you divide that by their actual earnings per share last year of 16, you can see this is 75% earnings growth per share, which again is massive growth, and I think just starting to ramp for this company. And last but not least, definitely not least, is cash and cash equivalents. So they have over $1.1 billion of cash or cash equivalents in their company right now. And if you recall on the previous slide, I said to hold on to that market cap number of 9.33 billion. You can see here now they have over 8.3% of their total market cap sitting in cash or cash equivalent. This gives them a lot of flexibility in terms of paying down debt, ramping up some of their new strategic projects, or the ability to actually buy shares back, which we'll talk about in a second here. Now, as we scroll down the page, we're going to move into the full year results for all of 2020. So very similar format here, but you can see the numbers obviously are a lot bigger because it's a full year's worth of activity. So revenue was just under $2 billion, $1.9 billion. Again, big double-digit 15% year-over-year growth and 16% if you take that currency exchange out. Average revenue per paying user was $128 compared to $123, so very similar story as above with about a $5 or $5.50 increase year over year. Gross margin was up 78% compared to 75% prior year. And this is awesome to see because as a business evolves, a lot of times their margins remain flat or actually go down as the business environment changes, or maybe there's some additional competitive pressures or stuff like this. So for the margin to actually be going up, and this is a fairly well-established business, it's not like Dropbox is a brand new startup. This is great to see. Now operating margin, again, if we take the one-time GAAP exception out of there, was 21.4% as compared to 12.3% the previous year. So almost doubled in terms of operating margin. Net loss was $256 compared to $53 prior year. If we strip GAAP out of there, you're looking at a $391 million profit compared to $207 in the prior year. So that one's up just about 100% again. Net cash was $571 million compared to $528 the prior year. And free cash flow was up substantially, $491 million compared to $392. So you can see net cash improved by about $42 million, whereas free cash flow actually improved by $98 million. And that's because those those margins are continuing to improve. So earnings per share recorded a loss of 62 cents compared to a loss of 13 cents in the prior year. And on a non-GAAP diluted basis, they actually earned 93 cents per share as compared to 50 cents in the prior year. So up 43 cents a share, or over 80% on a per share basis. So a lot of people would read those numbers and that's kind of where it would stop. And if you were just finishing your analysis there, you might have looked at that and said, hey, some of the numbers were a little lower year over year. On a GAAP adjusted basis, they actually lost money. I don't know if this is maybe the best investment for me, but you really need to read down the page here and go into detail. So there were two big things that people would have missed if they just looked at the numbers themselves. So number one were this material impairment charge. So Dropbox in the fourth quarter of 2020 announced this new virtual first work model. So they're essentially telling all their staff work from home is the default and they're going virtual as a company, which I think is the way a lot of companies are going to go into the future here. And it's great to see that they're actually leading that. They also did a big layoff, if you remember, a few months back, and this was part of that transition to this new business model. So they are going to retain a portion of their office space to be used for team collaboration and actually subleasing, and if people need to go into the office for whatever reason. But the vast majority of it, they've actually reassessed based on current real estate values and fair value of their office space and sublease availability. And they, as a result, took an impairment charge of nearly $400 million in the fourth quarter of 2020. So essentially what they did is they said, okay, here's all the space that we currently lease or own. This is what it's worth as of today's value. And keep in mind right now, office space is not very expensive because of the pandemic. And obviously a lot of companies are now shifting to work from home. So the result was the amount they had invested in this space is actually more than what it's worth now. And the difference was this impairment charge, or this one-time hit of $400 million that they took. Now they did note that they could have further charges of $0 to $50 million depending on current market conditions. So if the office space landscape continues to deteriorate, this space could actually continue to go down in price and they might have to take further impairment charges. But honestly, I feel like they were pretty fair with this, and I don't see that happening in any material way. You can see the bulk of it was actually taken in 2020. That's now behind them. And the nice thing about this is now they don't have to pay any of the upkeep, the overhead, or any of the high costs associated with brick and mortar locations, and they're going to start to realize a lot of these cost savings and synergies moving forward. The second note here, which I think is phenomenal for this company, is on February 12th, the board of directors authorized a repurchase plan of $1 billion worth of shares. So what this means is the company actually feels like they're so undervalued that their money is best spent buying shares off the open market of their own company. So again, if we look back at that market cap of $9.33 billion, and you consider they're now going to be purchasing back $1 billion worth of their own shares, that's almost 11% of the float right now. So essentially what that means is earnings per share, revenue per share, free cash flow per share, all of those metrics are going to go up by 11% because there's fewer shares available for the general public to purchase. That's why I'm excited actually to see the share price of Dropbox falling in recent days here, because this allows the company to get shares at a cheaper rate and essentially buy up more of their float. So in the short term, I'm actually not too upset if Dropbox continues to downtrend, because this is good for a long-term investor like myself. Now, if you have option contracts with short expiration dates, it's maybe a different story. But that's why I always give myself some wiggle room, and my current option strategy on this is dated out into summer, and then summer actually January of 2022. So I've got some time to allow this process to take place. So that last slide we looked at was kind of the high level summary or bullet point notes of Q4 and F20 earnings. Now, what you see here is actually from the Motley Fool website, but it's the full earning transcript. So this is actually where the senior leaders went on. They talked about the Q4 and 2020 results, and then they were able to ask questions. And of particular interest to me was HelloSign. So in my video on Dropbox that I posted a couple weeks ago, I talked about HelloSign as a big competitor, an up-and-coming competitor to DocuSign, and I looked at DocuSign's market cap compared to Dropbox. So I really wanted to see what analysts were asking about HelloSign and how the executive team responded. So if you go in here and you actually do a Control F, you can see that HelloSign was mentioned 23 times on this earning transcript. So obviously there's a lot of attention on that, and I highlighted a few paragraphs that I really wanted to point out here. So this first one talks about the need for Dropbox as a core service in 2020 with the work from home model. It also talks about elevated engagement and the attempt for Dropbox to better support their customers as they adapt their product roadmap quickly and make investments in content collaboration capabilities and new product launches. So one example of this was HelloSign, which is an e-signature platform. And you can see here, they really ramped up deeper integration into their Dropbox software itself, making it easier to sign documents without actually leaving the Dropbox ecosystem. They launched HelloSign in 21 additional languages, so again, trying to really expand that global presence. And they're actually now starting to cross-sell to their existing Dropbox user base, which if you remember is over 15 million paying users. So a massive captive audience here, and very easy for them to cross-sell this product to people who are already happy and paying for the Dropbox service itself. Now, by taking these actions, they actually saw annual recurring revenue, end user paid seats, and more than 70% increase in end user signature requests from HelloSign this year. So you can see they're starting to ramp this product very aggressively, and that's what's so nice about having all that cash on the sideline, is they're able to invest and really push initiatives like this forward at a quick pace. So this next section is actually a question from one of the analysts that covered Dropbox, and you can see a lot of attention again about HelloSign from the investment community and the analysts that cover this company. So Drew Houston, again, CEO here, answered this question. He said that HelloSign is the fastest growing product in the company. We saw strong growth in revenue in paid seats and signature requests last year. So that's that 70% number we just mentioned. And I think in the pandemic really accelerated the adoption of e-signature as a category. And we've made big investments in accelerating HelloSign's growth. We're excited about it, including more seamless integration with Dropbox or with core Dropbox experience, internalizing HelloSign, adding support for 21 languages, which we saw, and they still consider this to be the very early innings for both HelloSign in the product category itself and e-signatures overall. So then to end off, they quickly talk about the competitors in this space and note that Dropbox scale along with HelloSign scale is a big advantage, as a lot of people are now starting to use e-signature platforms, and once you're kind of set up with one, you really don't switch around a lot. So they see this as an opportunity to lock these people in and get those users on a consistent basis moving forward. Now the final piece of news I wanted to talk about here, this one actually just came out on Monday. So Dropbox has also announced $1.1 billion convertible note offering. Now they haven't released any of the interest rate details, but the notes themselves are due on March 1st of 2028. So they're dated out about 8 years from now. And essentially what this does is a loan for the company based on a predetermined interest rate that they can then leverage this money over the next 8 years to focus on different business initiatives and then pay these lenders back at a future date. So again, this gives them more flexibility with their share repurchase program, with launching stuff like HelloSign, and just overall health of the business, because they don't have to worry about ever being cash poor or running out of money and having to wait to fire up an initiative or a project that they're looking to do. So more details to come on this one. You can see here the interest rate, conversion rate, and other terms of the note are to be determined upon pricing of the offering. So there's not a lot of details here, but the key is that the company's thinking about the future and they're getting their balance sheet in a spot where they have the ability to execute on their different decisions at a very fast pace with a fast turnaround. So that's it for today's video, you guys. As mentioned previously and in other videos, I'm very bullish on Dropbox overall. I own about $8,000 worth of shares and an additional $3,000 worth of call options on this company. I did mention they're dated out into the summer and early next year, so they're not short-term call options, but I personally think this is a short-term pullback in share price. I think this is a great buying opportunity for this company. I think their market cap combined with their cash position, their share repurchase program, and their 2020 earnings just scream value for this company. This is definitely one I'm going to be looking to add to, and anything around that $20 price point, in my opinion, is just easy money. Now, if you haven't already taken a second to like the video and subscribe to the channel, please do so. Let me know in the comment section below if you like Dropbox, if you currently hold any shares, and how you're playing this name. And as always, please make sure you have a great rest of your day.